The first thing we need to talk about is the Diagnostic and Statistical Manual of Mental Disorders. For those that don't know, this is the manual for the classification of mental disorders using standardized criteria. This is the guidelines, the rules, the Bible of every member in the field of psychology. Now, you might be wondering exactly what in the Lambo Town does this have to do with GameStop and AMC? Well, we know that even though bulls on these stocks far outmatch in numbers the amount of people shorting it, shorters still line up to get hurt. As such, it is important to relegate and diagnose every single individual who buys short positions on meme stocks as mentally handicapped. They suffer from a masochistic disorder which should be looked at and treated by a professional. In no way, shape or form should anyone ever again place a bet against meme stocks, the reason being that meme stocks is nothing but a direct subsidiary of the internet, and you never ever dare the internet to not do something. There is no fundamental analysis done, no reasonable cause or existing evidence that makes the shorting of meme stocks a viable course of action. Proceed at your own unbecoming, because you will be reduced to ashes, to atoms when this thing does squeeze. So, let's bring the topic back to today. Why are we surging and running the way we are? Let's talk about it. This channel has been based around theory for the most part. We have speculated about what we have usually believed to be the variables and factors that make meme stocks tick, if you know what I mean. We have uncovered naked shorts, options, failed to deliver securities, and recently we have talked about swaps and futures. They have all contributed as consistent forces that are used to beat meme stocks and keep prices low so as to not have them run by themselves, which would eventually cause enough margin calls that would ignite the biggest squeeze of all time. Now, let us gather some clues. Looking at the one-year chart, we notice a could differently patterns on GameStop. By the way, the general patterns of this are also seen on the AMC chart, but I will use GameStop as the primary example because I have studied it longer and feel more comfortable. Do know, however, that all the things we will talk about also apply to AMC, so don't freak out and think this topic is GME-centric. So, when we look at these charts, the first pattern that we see is that GameStop, as well as AMC, have continuous growth over elongated time frames. Each stock seems to experience a resounding surge over time, which is followed by a retracement. The stock consolidates for a period, and then starts running up. When it retraces again, it never falls back exactly to where it was before. Instead, the stock retains a gain, a higher floor. That is what we notice when looking at the chart. The second impression, which in my opinion is more important, is the time frame. It seems to me that meme stocks restart the cycle every 2 to 3 months. Surge, retracement, and consolidation. Having these clues, we can more easily deduce and pin back what is happening. In a video that came out around 1 to 2 weeks ago, we talked in great detail about swaps, or credit default swaps to be more precise. We talked in great detail about the role that broker-dealers had on that video as well. We then had a huge video this past Saturday where I went back and revised the 2020 Citadel Securities Report. In it, we found a lot of evidence that suggested to us who the friendly participants are with Citadel, and most included banks. Combining these two videos, we arrive at certain conclusions. Now that we have pointed out all the different threads, let's start weaving them together to make sense of everything. We know that credit default swaps have premium payments. It is essentially how one party benefits from it. As it just happens to be, these payment dates just happen to take place on March, on June, on September and on December. Now take a look at the chart and pay close attention to the months where we experience the surge part of the cycle. You creaming and screaming yet? Good. I hope not, because this is not everything. Now, we talked about banks a little while ago. I am going to call names out right now, but do know these are not the only participants I strongly believe to be taking part in this. Please buckle up and put your tin-foil hats, because we are about to go into uncharted territory. We know Bank of America has been acting extremely weird lately. The amount of bonds they have set have raised eyebrows all across the world. Why does this bank need so many loans out of nowhere? I know exactly why, and I hinted to it on that one video talking about swaps. If you paid attention, you know exactly where I am going: credit default swaps. GameStop and other meme stocks have been in dangerous waters. Their businesses have suffered a lot through the last couple of years. As such, they have had to take loads of loans. Banks saw this, and started placing bets against these companies through credit default swaps. Bank of America, JP Morgan and sweet old baby Jesus knows how many other big banks saw the situation and decided to bet against meme stocks, which weren't even known as that back then. These clowns approach hedge funds such as Citadel or Virtue or whatever other ones exists, which were the ones that had made a deal with the banks that provided loans to the meme companies. These banks then tell the hedge funds and other institutions and tell them they want to start taking synthetic positions for credit default swaps, which would be using the same underlying asset, in this case GameStop, AMC and the rest of the other stocks. The moment they did this, they made the original credit default swap not work as intended, and instead it become a bet, a short bet that is. To make it a little easier for you less wrinkled smooth operators, the banks placed a bet that these companies were not going to be able to pay off their loan. They bet against their ability to come back. Well, as ironic as it may seem, these companies have been coming back, with AMC have astounding revenue and GameStop having paid off in full all of their loan. So, the banks are now stuck with this bag of short bets that they can't even begin to imagine how they will pay off. The company's valuation at those times were nothing to what they are now, and people keep on buying like it's Black Friday. The losses are well in billions if not trillions yet. The entire valuation of these institutions have been erased, and they know it. It's just a matter of time until they sink completely, and that's when things are going to get interesting. Let's rewind and review. The reasons why we are surging now can be traced back to certain predictable cycles. Using this knowledge, we were able to deduce that credit default swaps payments line up quarterly, aligning perfectly with the surge portion of the cycle. We will experience this surge and get some tendies, and then we will retrace back, but above from where we were, even if it is by single-digit figures, but we will be higher. I have just explained credit default swaps and their role. If you need a more detailed explanation of this, I will link the video I had made talking about this where I break it down a little further as if you are brand new to stocks. I hope this explanation was basic, like my wife, and simple enough for you to comprehend the why we are surging and why we will go down. It's all part of the process. This is not the squeeze we want, so don't get too hyped. I don't think we see that yet as hedge funds and banks all have successfully been able to manage their current positions so as to produce money to keep kicking the can down. However, this ability does have an expiration date. I want to ask you to share this video and like it if you found it useful and quick. Also, don't forget to give me feedback on the comments. Do let me know if you are content with this explanation and feel satisfied. Let's talk about today. The Fed reported that reverse repo operations for today resulted in over $1.129 trillion, which is a very slight decrease over yesterday's historic benchmark. AMC's dark pool transactions accounted for 67% of the total volume, while GameStop dark pool transactions accounted for 45% of the total volume today. According to Fidelity data, buy order flow for AMC was bigger than the sell order flow, with GameStop's buy order flow being almost twice as big as the sell order flow. Now, let us finish up with a recap of today's performance. GameStop. Baby, what can I say about this stock other than you are my soul and butter? Today we rose over 27%, an incredibly huge run-up. We opened to a small surge, then had a relatively long consolidation period after that small retracement. The stock then started running all the way to 225. The stock was met with a retracement and short attack, but it bounced up and started a bullish wedge. It closed at 210.29, well above the VWAP. As for what to expect tomorrow, no idea. This surge is not to be done with just one day, and I think that especially during the month of September where increased volatility is highly expected, we can see a lot of things. As such, I have no value or proposition to tell you other than I think the surge will continue going, even if not directly tomorrow, but over the next couple of days and perhaps weeks. We might dip hard and then work our way up. I do want the stock to consolidate and not keep running vertical because it will be super easy for hedge funds to undo what we have done. AMC followed along with a massive run, gaining over 20% today alone. The stock had a horizontal performance during the pre-market, but with a slight inclination upwards. Upon market opening, AMC had a brief run-up that was followed by a retracement. The stock consolidated a bit and then had a huge run all the way up to 48.20. The stock was then met with a retracement and short attack, which it then bounced off from and closed at 44.26, well above the VWAP. As for what to expect tomorrow, again, I have no idea. The run could keep going, or it could dip. I highly think that we will maintain a lot of volatility and keep on going over the next few weeks, constantly testing resistance walls and perhaps run back to the $70 mark again. Whatever you do, stay bullish. Thank you for making it to the end of the video. Like I said, I have a major piece of DD to share with you guys. I will be on the lookout for an opportunity to share it when we aren't having a dopamine rush like we do right now. We covered a lot, so please do take an opportunity and let me know how you feel about this down on the comments below. I want to be able to keep improving videos so that you guys can understand what's going on in a much easier way, and feedback is crucial. If you don't mind, drop a like on the video to help the video get around. If you want to help this channel, I have provided links which will be in the description. This goes a long way in helping me be able to pump videos out, as I have quit my job and abandoned other activities to do this full time to keep you guys informed. Remember to follow me on Twitter if you haven't already, and I hope to see you guys tomorrow on the next one. To the moon.